Topic introduces default probabilities as a fundamental component of credit risk measurement and management. Default probability represents the likelihood that a borrower or counterparty will fail to meet contractual debt obligations within a specified time horizon. Financial institutions rely on default probability estimates to price loans, evaluate creditworthiness, determine economic capital, and calculate expected losses. These probabilities may be derived from historical default data, market-based indicators, internal rating systems, or structural credit risk models. Higher default probabilities indicate greater borrower risk and therefore require higher interest spreads or additional collateral protection. Accurate estimation of default probabilities is essential for maintaining financial stability and supporting prudent credit decision-making. The topic further explains different methods used to estimate default probabilities. Historical approaches rely on long-term default experience associated with specific credit ratings or borrower categories. Market-based approaches derive implied default probabilities from bond spreads, equity prices, or credit default swap spreads that reflect investor expectations. Structural models, such as the Merton framework, estimate default risk based on a firm's asset value relative to its debt obligations. Reduced-form models treat default as a probabilistic process influenced by macroeconomic and market variables. Each methodology provides unique insights into borrower risk, though all depend on assumptions regarding market behavior, recovery rates, and changing economic conditions. A key concept is the term structure of default probabilities, which examines how default likelihood changes over different time horizons. Short-term default probabilities are generally lower for financially stable borrowers but may increase significantly during periods of economic stress or declining credit quality. Longer-term probabilities incorporate uncertainty regarding future market conditions, business performance, and refinancing risks. Financial institutions analyze cumulative default probabilities to estimate the total likelihood of default over multiple years. These estimates support bond valuation, portfolio management, and stress testing activities. Understanding how default probabilities evolve over time helps institutions assess credit exposures more effectively and allocate capital appropriately. Topic also focuses on credit risk in derivative transactions, where exposure arises from the possibility that a counterparty will fail to fulfill contractual obligations. Unlike traditional loans, derivative exposures fluctuate over time because contract values depend on changing market prices such as interest rates, foreign exchange rates, or commodity prices. Counterparty credit risk therefore includes both current exposure and potential future exposure. Current exposure reflects the replacement cost of a contract if default occurs immediately, while potential future exposure estimates how exposure may increase due to future market movements. Financial institutions actively manage these risks through collateral agreements, netting arrangements, margin requirements, and counterparty credit limits. The topic also examines the role of central counterparties and risk mitigation techniques in reducing derivative-related credit risk. Central clearing organizations reduce bilateral counterparty exposure by becoming the intermediary between derivative counterparties. This process improves transparency, standardization, and systemic risk management within financial markets. Financial institutions additionally use collateralization and margining to reduce unsecured exposures and protect against sudden market volatility. Credit Valuation Adjustment, CVA, has also become an important concept because it measures the market value adjustment required to reflect counterparty credit risk within derivative pricing. These mechanisms collectively strengthen financial stability and reduce the probability that derivative defaults will trigger widespread market disruptions. Topic also introduces default correlation and its significance in credit value at risk, credit VAR, modeling. Default correlation measures the extent to which borrowers are likely to default together due to shared economic or financial conditions. Low default correlation supports diversification because losses across borrowers occur independently. However, during economic recessions or systemic crises, correlations often rise sharply, increasing the likelihood of simultaneous defaults and substantial portfolio losses. Financial institutions therefore analyze correlations carefully when estimating portfolio risk and economic capital requirements. Ignoring default correlation can significantly underestimate the tail risk associated with large, diversified credit portfolios and structured finance products. The topic further explains how default correlation influences credit VAR calculations and portfolio loss distributions. Credit VAR estimates the maximum expected portfolio loss over a specified horizon and confidence level. When correlations increase, the distribution of potential losses becomes wider and more heavily concentrated in the tail, reflecting greater systemic vulnerability. Financial institutions use statistical models, copulas, and simulation techniques to estimate correlated defaults and measure portfolio risk more accurately. Stress testing and scenario analysis also help institutions evaluate how severe economic downturns affect default relationships. These tools improve understanding of concentration risk and support stronger portfolio diversification and capital management strategies. Finally, topics emphasize the interconnected nature of default probabilities, counterparty credit risk, and portfolio correlation within modern financial systems. Accurate estimation of default risk supports loan pricing, derivative valuation, portfolio construction, and regulatory capital assessment. Derivative markets introduce additional complexity because exposures fluctuate dynamically and are highly sensitive to market volatility. Default correlation further amplifies systemic risk during periods of financial stress by increasing the likelihood of widespread credit losses. Financial institutions must therefore combine quantitative models, market indicators, stress testing, and strong governance practices to manage credit exposures effectively and maintain resilience against adverse economic and financial conditions.